Welcome to Wealth Echelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button and don't forget to turn on the bell for updates on all our latest content. In today's unpredictable market environment, where volatility often sends even the most reliable stocks tumbling, savvy investors are on the lookout for hidden gems, especially among dividend-paying companies. Imagine being able to buy shares in some of the strongest, most dependable dividend stocks, but at their lowest prices in a whole year. These 52-week lows don't just represent a simple dip in price. They could be the gateway to exceptional income and long-term growth that many investors dream of. Why pay full price when you can pick up solid companies with proven dividend histories at a discount? It's like buying quality real estate during a market slump. When everyone else is fearful, the patient buyer stands to benefit the most. The beauty of investing in dividend stocks at their 52-week lows is twofold. First, you increase your potential for capital appreciation when the market eventually bounces back, riding the wave of recovery for potentially substantial gains. Second, you lock in higher dividend yields on your investment right now, since dividends paid on a lower stock price translate to a better return relative to your cost. This means your portfolio starts generating more income per share from day one, which can be reinvested to compound wealth faster. However, this rare moment where patience meets opportunity requires careful consideration. Not every stock that hits a 52-week low is a bargain. Some may be facing fundamental challenges that threaten their dividend sustainability or long-term viability. The key lies in differentiating between temporary setbacks, such as industry-wide downturns, regulatory hurdles, or short-term earnings misses, and deep-rooted issues that could signal permanent damage to the business. Understanding these nuances is critical because the last thing any investor wants is to fall into a value trap, where a stock looks cheap but continues to decline or cuts its dividend. In this guide, we'll explore the driving forces behind these price declines, from macroeconomic trends like interest rate fluctuations and inflationary pressures, to sector-specific challenges affecting utilities, energy, financials, and consumer staples. We'll highlight how these external factors create volatility, but also pave the way for strategic investment opportunities. Additionally, we'll spotlight 5 dividend stocks currently trading at their 52-week lows, examining why they have dropped, what makes their dividend policies sustainable, and why they could be the cornerstone of your next investment move. Whether you're a seasoned income investor seeking to boost your yield or a newcomer eager to build a steady stream of passive income, understanding how to identify and capitalize on dividend stocks at their lows can transform your financial future. These investments not only provide immediate cash flow, but also the potential for capital growth, making them ideal for building a resilient, balanced portfolio in uncertain times. So buckle up and get ready to uncover how disciplined, well-informed investing in dividend stocks at their 52-week lows can set you on the path toward greater financial security and wealth accumulation. The market's downturns are not just moments of risk, but also moments ripe with opportunity, if you know where to look. Understanding the opportunity in dividend stocks at 52-week lows. Dividend stocks are a favorite among investors looking for reliable income streams and long-term wealth accumulation. These stocks pay regular dividends, providing a steady cash flow irrespective of market volatility. When such stocks hit their 52-week record lows, it often signals a potential buying opportunity. This low price point can occur due to various reasons: market overreaction, sector-wide downturns, or temporary company-specific setbacks. For income-focused investors, these lows can be a golden entry point to accumulate shares at a discount, increasing future yield on cost and positioning for capital appreciation when the market corrects itself. Historically, many dividend stocks that have fallen to their 52-week lows rebounded strongly over time, rewarding patient investors with both dividends and price appreciation. However, it's important to distinguish between a mere market dip and a fundamental decline in a company's financial health. Thorough analysis is critical to avoid value traps. stocks that remain depressed due to deteriorating fundamentals. Hence, understanding why a dividend stock is trading at its yearly low is the first step in unlocking its potential as a lucrative investment. The significance of dividend yield and stability during market dips. One key advantage of dividend stocks trading at 52-week lows is the potential for higher dividend yields. Dividend yield is calculated by dividing the annual dividend payment by the stock's current price. As the stock price drops, assuming dividends remain constant, the yield increases, making the stock more attractive for income-seeking investors. However, an unusually high dividend yield can also be a red flag, signaling that the market expects a dividend cut or that the company is facing difficulties. Therefore, assessing the stability and sustainability of dividends is vital. Companies with strong cash flow, manageable debt, and a history of consistent dividend payments tend to maintain their dividends even during market downturns. These companies provide a cushion for investors by delivering income when stock prices are low, helping offset paper losses. Additionally, reinvesting dividends during low-price periods accelerates the compounding effect, potentially boosting long-term returns significantly. Investors should look for firms with a track record of growing dividends, as this often reflects management's confidence in future earnings and cash flow stability. Sector dynamics and why some dividend stocks hit new lows. Dividend stocks span across many sectors, but not all sectors behave the same during economic cycles or market corrections. Certain sectors are more sensitive to interest rate changes, economic downturns, or commodity price swings, which can cause dividend stocks within those sectors to hit 52-week lows. For example, utility and real estate stocks, known for their high dividends, might decline sharply when interest rates rise, as their fixed income-like characteristics become less attractive. Similarly, energy stocks paying dividends might fall if oil prices drop due to global supply-demand imbalances or geopolitical tensions. Financial sector dividend stocks could be pressured by credit risks or regulatory changes. Understanding sector-specific risks helps explain why certain dividend stocks are at their lows and whether those reasons are transient or structural. Investors who can identify temporary pain points versus permanent damage can capitalize on undervalued stocks that are poised for recovery once conditions improve. For instance, companies in sectors expected to rebound from economic slowdowns or benefit from stimulus packages often present compelling value when trading at depressed levels. Examples of 5 dividend stocks at their 52-week lows. To illustrate the concept, let's explore 5 dividend stocks recently trading at their 52-week lows, reflecting various sectors and unique situations. First, a major telecommunications company, known for its consistent dividend and essential service, may have seen its stock decline due to increased competition or regulatory hurdles. Despite the stock's low, the company's solid cash flow and infrastructure investments support its dividend, making it attractive for long-term investors seeking stability. Second, a consumer staples giant that typically provides steady dividends might have dropped due to supply chain disruptions or shifts in consumer preferences. However, its brand strength and market penetration allow it to maintain profitability and dividends, offering a good entry point during market weakness. Third, an energy firm heavily dependent on commodity prices could be at a 52-week low because of recent drops in oil or natural gas prices. While volatile, this company's dividend might be supported by prudent cost controls and strategic reserves, presenting an opportunity if commodity prices recover. Fourth, a financial services company might have been impacted by concerns about loan defaults or changing interest rate environments. If the fundamentals remain intact and capital adequacy ratios strong, this stock at a low price may offer an appealing yield with potential for price appreciation. Finally, a utility company with a long history of dividend payments may be experiencing downward pressure due to interest rate hikes or infrastructure spending uncertainty. However, utilities often provide reliable dividends supported by regulated cash flows, making them defensive plays during volatile markets. Each of these examples demonstrates different reasons for the price lows, but shares the common thread of dividend income stability or potential recovery. Strategies for investing in dividend stocks at 52-week lows. When investing in dividend stocks at their 52-week lows, investors should adopt a disciplined, research-driven approach. First, perform fundamental analysis to assess dividend sustainability, including payout ratios, cash flow health, and debt levels. Second, consider the macroeconomic environment and sector-specific factors influencing the stock's price. Third, diversify across sectors and geographies to mitigate company-specific and market risks. Fourth, take advantage of dollar-cost averaging by investing gradually to avoid timing pitfalls. Fifth, monitor dividend announcements and earnings reports closely for signs of dividend cuts or financial distress. Another strategy is to focus on dividend growth stocks, which not only pay dividends, but have a record of increasing payouts annually. Buying such stocks at lows can maximize long-term compounding benefits. Additionally, investors can complement dividend stocks with other income-generating assets like bonds or REITs to create a balanced income portfolio. Maintaining a long-term perspective is crucial when investing in dividend stocks at their 52-week lows. Market downturns and price declines can often trigger emotional reactions, such as fear or impatience, tempting investors to sell at a loss or avoid buying altogether. However, history has repeatedly shown that the stock market tends to recover over time, and companies with solid fundamentals typically rebound, restoring their stock prices and sometimes even reaching new highs. This recovery process may not be immediate. It often requires months or even years, but the patience to stay invested can result in handsome rewards through both capital appreciation and dividend income. One of the most powerful tools investors have during these downturns is dividend reinvestment. By reinvesting dividends when stock prices are depressed, investors effectively buy more shares at lower costs, which accelerates the compounding effect. This means your portfolio doesn't just grow from price appreciation alone, but also from an increasing number of shares generating dividends in the future. Over time, this cycle of reinvestment can significantly boost total returns, turning temporary setbacks into long-term growth opportunities. Moreover, embracing patience through periods of volatility allows investors to capture the full benefits of dividend investing, consistent income combined with the potential for capital gains. While the share price may fluctuate in the short term, the dividend stream provides a cushion, offsetting price declines and offering a reliable cash flow. This steady income can be especially valuable during uncertain economic conditions, providing financial stability and peace of mind. In summary, dividend stocks trading at 52-week lows present compelling opportunities for disciplined investors who perform thorough due diligence and apply sound investment principles. By carefully selecting companies with strong balance sheets, sustainable dividends, and positive long-term prospects, investors position themselves to benefit not only from recovering stock prices, but also from enhanced dividend yields. The combination of patience, reinvestment, and strategic selection turns these market lows from periods of risk into launching pads for building wealth over time. Thank you for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.